Hello everyone. The topic of today's lesson is an overview of financial evaluation. The learning objectives for this session are to familiarize with the concepts, purposes, methods, steps, and basic principles of financial evaluation. First, let's discuss the concept of financial evaluation. Financial evaluation, also known as financial analysis, is based on the country's current fiscal and taxation systems, pricing systems, and relevant regulations and provisions. From the perspective of the enterprise or project itself, based on the estimation of financial benefits and costs, and the preparation of financial auxiliary statements, it analyzes and calculates the direct financial benefits and costs of the project, prepares financial statements, calculates financial analysis indicators, examines and analyzes the project's profitability, debt repayment ability, financial viability, and other financial conditions. This is used to evaluate and discern the financial feasibility of the project and provide a basis for investment decisions. Financial evaluation should be conducted on the basis of a preliminary determined construction plan, investment estimation, and financing plan. It is closely related to the previous stages of feasibility studies. For example, investment, costs, and profits are all derived from initial investigations. Investment estimations are related to the proposed scale. Costs are related to resource conditions and raw material prices. And profits are estimated based on product market forecasts. Therefore, feasibility studies are the foundation for project financial evaluation. However, the results of project financial evaluation can also be fed back into the design of the plan for comparison and optimization of the plan design. Therefore, financial evaluation and project plan selection are a repeated comparison process. The results of financial evaluation are an important part of the conclusions of project feasibility studies. So, financial evaluation is also the core content of project feasibility studies. Next, let's discuss the purposes and roles of financial evaluation. First, from the perspective of the enterprise or project, analyze the effects of investment and the benefits that the enterprise will obtain from it. Project investors and operators are very concerned about the project's profitability, rate of return, and debt repayment ability. Financial evaluation provides relevant data results for enterprise owners and operators. So, financial evaluation, among them, the profitability of project investment, is a basic indicator of evaluating the financial feasibility of the project, and is also the primary factor considered when enterprises make investment decisions. Second, evaluate the project's loan repayment ability. This mainly examines the project's ability to repay loans on schedule, which is directly related to the enterprise's financial risks and credit rating. The debt repayment ability is an important basis for corporate fundraising decisions. Third, provide a basis for enterprises to formulate fund planning. The investment scale of the construction project, the possible sources of funds, the arrangement of fund disbursement plans, and the choice of financing schemes are all issues that financial evaluation needs to address. Fourth, provide a basis for coordinating enterprise interests and national interests. For some projects that have good national economic evaluation conclusions, but are financially infeasible and urgently needed for the national economy and people's livelihood, it may be necessary to propose suggestions to the government for adopting economic preferential measures to make the project financially viable. At this time, financial evaluation can provide a basis for determining the preferential methods and magnitudes. Fifth, provide a basis for cooperation between Chinese and foreign joint venture projects. Contract terms are the primary prerequisite for cooperation between Chinese and foreign joint venture projects, and the formal signing of the contract cannot be separated from economic benefit analysis. In fact, the negotiation process of contract terms is the measurement process of financial evaluation. Therefore, financial evaluation is the sole basis for project decision-making. Through learning the concept and role of financial evaluation, we have a preliminary understanding of it. Now let's further study the content and indicator system of financial evaluation. The content of financial evaluation mainly includes profitability evaluation and solvency evaluation. First, profitability is the primary indicator, reflecting the financial benefits of a project. In financial evaluation, it is necessary to investigate whether the proposed investment project will be profitable after completion, how much profitability it has, and whether the profitability meets the requirements for project feasibility. Second, solvency includes two levels. One is the project's financial solvency, that is, its ability to recover all investments. The other is debt solvency, mainly referring to the project's ability to repay loans and settle debts. It is directly related to the financial risks and credit ratings faced by enterprises, and is an important basis for their financing decisions. The Financial Evaluation Indicator System for construction projects is established according to the content of financial evaluation, and is closely related to the prepared financial evaluation statements. The relationship among the content of financial evaluation for construction projects, evaluation statements, and evaluation indicators can be seen in the Financial Evaluation Indicator System table in the book. After understanding the content of financial evaluation, the next step is to learn how to apply the financial evaluation system. The specific evaluation steps are as follows. Financial evaluation is conducted on the basis of market research and technical research for the project. It mainly utilizes relevant basic data, prepares financial statements, calculates financial evaluation indicators for financial analysis, and makes evaluation conclusions. The procedure roughly includes the following basic steps. 1. Prepare basic data and parameters for financial evaluation. This includes basic data and parameters such as the financial prices of major inputs and outputs, tax rates, interest rates, exchange rates, calculation periods, depreciation rates for fixed assets, amortization periods for intangible assets and other assets, production loads, and benchmark yield rates. 2. Estimate operating revenue and costs. Operating revenue and costs are important foundations for financial analysis, and their accuracy and reliability have a significant impact on the project's financial analysis. When estimating, the principle of comparison with and without is generally followed to correctly identify and estimate the operating revenue and costs under the states of with the project and without the project. 3. Prepare auxiliary financial analysis statements based on the results of the project's market analysis and implementation condition analysis, as well as current relevant laws, regulations, and policies. Analyze and estimate a series of financial basic data related to the project, and compile the obtained data into auxiliary financial analysis statements. These generally include the construction investment estimation statement, working capital statement, construction schedule, fixed asset depreciation cost estimation statement, intangible asset and deferred asset amortization cost estimation statement, fund use plan and fundraising statement, sales revenue, sales tax and surcharges, and VAT estimation statement, and total cost estimation statement. 4. Prepare basic financial analysis statements. Aggregate the basic data on investment, expenses, and benefits to separately prepare basic statements, reflecting the project's financial profitability, solvency, and viability. These mainly include the cash flow statement, profit, and profit distribution statement, sources, and uses of funds statement, balance sheet, loan repayment schedule, and financial plan, cash flow statement. 5. Calculate and analyze financial evaluation indicators. Based on the prepared basic financial statements, we can directly calculate a series of indicators reflecting the project's profitability, debt repayment ability, and financial viability, so that analyze and judge the financial feasibility of the project. Clarify the project's value contribution to the financial entity and investors, and provide a basis for project decision-making. 6. Conduct uncertainty and risk analysis through uncertainty analysis methods, such as break-even analysis, sensitivity analysis, and probability analysis. Analyze the risks the project may face, and its ability to adapt to market changes, and resist risks under uncertain conditions, and draw conclusions on the project's financial evaluation under risky conditions. 7. Prepare a financial evaluation report. Compare the above analysis results with benchmark values published by relevant national departments, or with empirical standards, historical standards, target standards, etc., and draw conclusions on the feasibility of the project from the perspective of the enterprise or project itself. Now let's learn about the main financial evaluation methods. The basic methods of financial evaluation include deterministic evaluation methods and uncertain evaluation methods. Depending on different standards, the methods can be classified differently. 1. Classification by the nature of evaluation methods. Financial evaluation methods can be classified into quantitative analysis and qualitative analysis, according to their nature. Quantitative analysis refers to the analysis method for measurable factors. Qualitative analysis is an estimation analysis method for important factors that cannot be accurately measured. In financial evaluation, should adhere to the principle of combining quantitative analysis with qualitative analysis, with quantitative analysis as the main focus. 2. Classification by whether the evaluation method considers time factors. Evaluation methods can be divided into static analysis and dynamic analysis, based on whether they consider time factors. Static analysis does not consider time factors, while dynamic analysis does. In financial evaluation, should adhere to the principle of combining static analysis with dynamic analysis, with dynamic analysis as the main focus. 3. Classification by whether financing is considered in the evaluation. Evaluation can be divided into pre-financing analysis and post-financing analysis, based on whether financing is considered. Pre-financing analysis examines the rationality of project design from the perspective of the project's overall profitability. Post-financing analysis, based on pre-financing analysis and a preliminary financing plan, examines the project's profitability, debt repayment ability, and financial viability under proposed financing conditions, and judges the feasibility of the project plan under financing conditions, mainly used for comparing financing schemes. 4. Classification by the timing of project evaluation. Project evaluation can be divided into pre-evaluation, mid-evaluation, and post-evaluation based on timing. Pre-evaluation has a certain degree of predictability, and thus some degree of uncertainty and risk. Mid-evaluation may require modifications based on changes in external conditions, and re-evaluation to determine The necessity of fully or partially revising the original decision. Post-evaluation summarizes and evaluates the correctness of project investment decisions and the effectiveness of project management during project implementation. Finally, let's learn about the basic principles of financial evaluation. First principle of consistency in calculation scope. For costs and benefits. Only by limiting the estimation of inputs, costs, and outputs, benefits, to the same scope, range, can the calculated net benefits truly reflect the return on project investments. If a certain project is included in the investment estimation, then the increased benefits due to the construction of that project should be considered. Otherwise, the project's benefits will be underestimated. Conversely, if the contribution of the project to the benefits is considered but the investment is not calculated, then the project's benefits will be overestimated. Identification of costs and benefits. Principle of comparison between with and without. The term comparison between with and without refers to a comparative analysis of the future state with the project implemented versus the future state without the project. With refers to the future state after implementing the project, and without refers to the future state without implementing the project. When identifying a project's benefits and costs, it is important to note that only the incremental benefits and costs, which are the differences due to the project's construction, should be considered. This excludes the influence of various conditions before the project's implementation and highlights the effects of project activities. Third principle of combining dynamic analysis with static analysis. With dynamic analysis as the main focus. The main difference between dynamic analysis and static analysis lies in whether time factors are considered. Dynamic analysis methods use compound interest calculations to account for the time value of money when analyzing and evaluating, thereby making value judgments. Its advantages lie in converting inflows and outflows of funds at different times into values at the same point in time, providing a common basis for comparing different schemes and projects, and reflecting future developments and changes. 4. Principle of prudence in determining basic data. The accuracy of financial analysis results depends on the reliability of basic data. A large amount of basic data required for financial evaluation comes from predictions and estimates, inevitably leading to uncertainty. To provide more reliable information in financial evaluation results, avoid risks due to optimistic estimates made by humans, and better meet the needs of investment decisions, it is very necessary to follow the principle of prudence when determining and selecting basic data. That's all for this video. Thank you.